Ever felt your phone buzz or your game controller rumble? That's haptic technology, making digital touch real. Immersion Corporation is a leader in this field, powering the sensations in your devices. They don't build the hardware, they license their patented software to the world's biggest tech, auto, and gaming companies. Their business is built on a vast portfolio of intellectual property, earning revenue from licensing deals. You'll find their tech in car touchscreens, medical simulators, and wearables, anywhere you feel a digital click. For years, Immersion has quietly shaped how we interact with technology. Their stock, IMMR, is a favorite for investors seeking exposure to interactive tech. The potential for haptics is huge. Imagine feeling textures while shopping online, or the recoil in VR games. But even innovative companies can stumble, not always from tech failures, but from issues behind the scenes. Today, Immersion faces a crisis, not from a rival, but from the Nasdaq exchange itself. This isn't about bad technology, it's about failing to meet the basic rules of being a public company. When a company's main asset is intellectual property, trust and transparency are everything. Immersion's current trouble is a warning sign for investors. The story isn't about their tech, it's about their ability to play by the rules. And when a company can't do that, it's a red flag no investor should ignore. Booyah! So, what's a Nasdaq compliance notice? Think of it as a warning from the stock market's principle. To stay listed, companies must follow strict rules. Timely, accurate financial reporting is at the core. These rules protect investors by ensuring transparency and fairness. Companies must file quarterly, 10Q and annual, 10K reports with the SEC, revealing their financial health. Miss a deadline, and Nasdaq sends a formal notice, you're out of compliance. The notice gives a deadline to fix the problem, usually by filing overdue reports. It's a serious red flag, signaling to the market that something's wrong. Investors hate uncertainty, and compliance notices create just that. If the company can't resolve the issue, Nasdaq can delist the stock, removing it from the exchange. Delisting is a disaster. It's harder to raise money and shareholders struggle to sell their stock. The process is designed to protect the market's integrity. For investors, a compliance notice is a wake-up call. It's not just paperwork, it's about trust. Ignore these warnings at your own risk. Immersion's problems didn't appear overnight, they've been brewing for months. The first major warning came in August 2025. Immersion failed to file its annual 10K report. This isn't a minor slip, the 10K is the company's financial report card. The reason? An ongoing audit committee investigation at both Immersion and its subsidiary, Barnes & Noble Education, BNED. When an audit committee investigates, it means something serious could be wrong with the numbers. Nasdaq demanded a plan to fix the issue, a promise to complete the investigation and file the overdue report. Investors watched closely, but patience was thin. The stock dropped. Uncertainty is poison for share prices. The delay suggested deeper problems at BNED were affecting Immersion's entire business. One late filing can be forgiven, but it puts the company on thin ice. Immersion's fate was now tied to resolving issues at its subsidiary. This first notice was a clear warning: fix the problems, or face consequences. The market doesn't just trust, it verifies. For Immersion, the clock was ticking. Investors needed answers, not excuses. The pressure was on. Before investors could catch their breath, Immersion got a second Nasdaq notice in late September. This time, they missed the deadline for their quarterly 10Q report. 2 missed filings in a row. Now it's a pattern, not a fluke. The ongoing audit investigation was still blocking financial reporting. Management was paralyzed, unable to close the books for any period. The same issues at Immersion and BNED were dragging on. Nasdaq had already accepted their first compliance plan, but now trust was eroding. The exchange could have delisted them, but gave more time. Barely. Investors were losing faith. The stock took another hit. 2 compliance notices signal a chronic problem, not a one-off mistake. The market started to question if management was in control. When a company can't file basic reports, everything else comes into doubt. The narrative shifted. This wasn't a hiccup, but a crisis. Patterns matter, especially when they're bad. Immersion's credibility was on the line. The risk of delisting was growing. Investors were on high alert. By December, Immersion received a 3rd compliance notice, this time for missing another quarterly report. 3 missed filings in a row: annual, first quarter, and now, the next quarter. The company blamed ongoing audit investigations at both Immersion and BNED. The real bombshell: they'd have to restate previous financials, meaning past numbers were wrong. Restating financials destroys management's credibility and investor trust. Nasdaq demanded an updated compliance plan by January 7, 2026. This time, Immersion had to prove they could actually fix things. The market's reaction was swift. The stock dropped again. Delisting risk was now front and center. If Nasdaq loses patience, Immersion could be kicked off the exchange. Delisting would devastate shareholders, pushing the stock to the illiquid OTC markets. 3 strikes. Immersion's problems were deep and complex. The cloud of uncertainty was darker than ever. Investors had to face the real risks. What's behind all this chaos? Immersion's accounting is tangled up with its subsidiary, BNED. Because Immersion consolidates BNED's results, any mess at BNED delays Immersion's own reports. Both companies' audit committees are investigating suspected errors, serious enough to require restating past financials. Immersion can't move forward until BNED's books are fixed. This lack of control leaves Immersion and its investors stuck in limbo. Complex corporate structures can spread risk like a contagion. The market hates uncertainty, and Immersion's repeated failures to file reports have created a black hole of information. Investors can't assess the company's health or value the stock. Each compliance notice erodes trust and confidence. Restating financials is a credibility crisis. Past numbers were wrong, and investors feel misled. Lawsuits and regulatory scrutiny often follow. The investigation casts a shadow of suspicion. Until it's resolved, investors fear the worst. The ultimate fear: delisting from Nasdaq. Delisted stocks are harder to trade and usually plummet in value. The risk of delisting is now priced into Immersion stock. Nobody wants to be left holding the bag. For investors, this is a textbook case of why transparency matters. When trust is gone, so is value. The market is spooked for good reason. What now? Immersion must submit a convincing compliance plan to Nasdaq by January 7, 2026. No more vague promises. They need a clear, credible timeline for completing the audits and restating financials. The company's management and auditors are racing to clean up the books. This isn't just about overdue reports, it's about correcting past mistakes. Once the plan is submitted, Nasdaq decides, grant an extension or move to delist. If Immersion gets more time, they must meet every new deadline. No excuses. The only real fix is filing all overdue and corrected reports. Until then, the threat of delisting hangs over the company. Immersion says it's working hard, but results, not promises, are what matter now. The road ahead is narrow and full of pressure. For shareholders, it's a tense wait. The next few months will decide Immersion's fate. Multiple compliance notices are a giant red flag. Don't ignore them. Immersion stock looks cheap, but the risk of delisting is real and dangerous. Watch for updates on their compliance plan and the January 7 deadline. Nasdaq's response will signal the company's short-term future. If an extension is granted, the next filing deadline is critical. Read the restated financials carefully. Look for the size and impact of the errors. This is about more than technology. It's about governance and trust. High risk means you need to do your homework. Sometimes, the best move is to watch from the sidelines. There are plenty of companies that aren't fighting for survival. Choose wisely.